Hey guys, John Novak with Next Gen Software Services. We're going to talk about trade management and our automated trading system. And I want you to know that in a next couple revisions, we're going to work on adding in a smaller time frame to manage automated system trades. For now, this is something that you're going to have to do on your own manually until the process is automated. One of the things that the automated system does is it does a really good job of giving you high probability trend trade looks. And it does all of the work on the large chart. So if you're going through our user guide and you're looking at, you know, potentials for trend trades and the rules and the triggers and all of the things that we teach you guys, again, you know, wait for reversals on the small chart, pulling back to areas. Anyway, the system, the strategy will do all of that work for you. It'll find you a high probability trade. The one thing that it does, though, it's only the large chart. There is no small chart when the system is looking at trading. And we use an ATM in the strategy, and the ATM, you know, puts in a big stop and big targets, and you can run any ATM you want. But what I want to do in this video is I want to walk you through the management rules that we teach, which are very simple. But there's a couple of things that you're going to have to do when you are trading the strategy if you wish for the best performance. So, one of the things that you're going to spend a lot of time with is looking at divergence on your smaller chart. Now, this is an old picture from 22, but we've been teaching this for a long time, and the rules are always the same. Divergences with strong small triggers and lower triggers with lower divergences usually make the market, the trend will still continue. Once you have small triggers inside of your large triggers and or 2 or 3 divergences, that's where the market will typically terminate a trend. And again, as we go through these pictures, again, when we have let's say a strong trend trade look and we get a trend trade, if you get a pivot with divergence, number one, you can leave your stop behind and then wait for a new pivot if you're above everything. If it's a lower divergence and it takes you out and you get out, you have to be very mindful that if the small triggers roll up, you need to get back in again. So, again, when you're doing management, a very simple rule is if divergence gets you out, small triggers rolling up above everything, get you back in again. And we'll take a look at a bunch of examples of that. Anyway, this is all on the website. One of the other things that we do in our trend trading, if you're long, whether the system gets long here or here, wherever it gets long, it doesn't matter. But whenever it gets long and you get a pivot, or a pivot at least from the edge of your trigger lines, you want to have a stop below that. The system is going to have a 60 tick stop, which would be off this screen. You don't have to risk that much money. That's a preset setting in the ATM that is not 100% the best, but it leaves a big enough stop that you can manage your position accordingly. The other thing that we're going to talk a lot about, let's just say you took a long signal. Again, a second lower divergence will get you out almost every time. Well, it should get you out if the small triggers are lower than they were last time. You got to get out. You don't know what's going to happen. Obviously, there's a huge amount of fibs here, but if you get an up bar with the small triggers up, just get back in again, and then you'll get the rest of your move most of the time. And that's what we call a continuation look when the small triggers roll over. Just going through a couple more pictures. These are all on the website, on the user guide, under the management section. But again, look, if you get a long signal and you get a second lower divergence, especially with small triggers crossed down, just get out. And then you'll end up losing no money, or maybe a point, or maybe make a point, or it's going to be insignificant. If you leave a 60 tick stop in with an automated strategy that doesn't know what's happening, you're going to be very unhappy. So if you leave your stop in at 60 ticks because the system just puts it there randomly with the ATM, and you're not managing your position with all of the good stuff that we've taught you over the last 25 years plus, 28 years, 30 years, really have to think about how you're managing your positions. But second lower divergence or second higher divergence, if you're short, is an absolute must, especially when the trigger lines are crossed against you. It's just super imperative that you cover yourself. The other thing, again, you could see it, assuming the system takes a short signal. Look, here's divergence, and here's another higher divergence. They're just warning you and warning you and warning you. And worst case scenario, if you survive the first one with a stop behind your pivot, you're not going to survive the second one. It's just not going to happen. And even in my documentation from 2023, if a new signal, you can take it. If no down bars and no closes below the triggers and your triggers don't roll over, you don't have to get back in again. So this is going to save you an enormous amount of money. And not losing a bunch of money is almost as important as making a bunch of money when you're day trading. The other thing, if you get a long signal and you run into one-to-ones, usually that's a really good spot to take majority of your money. For me personally, I like this as an absolute exit. You may say, I'll get my stop up behind the triggers if you wish to give it a chance. But usually divergence from a one-to-one with the trigger lines below the one-to-one is going to make the market go way down and usually take out the last low. So you can exit there, or worst case scenario, below your triggers, and then there's no reason to give away all that money when there's nothing here to help you. Look, once you get below here, this is the warning. Below here, there's nothing left to help you out. There's no reason to lose 60 ticks. Please don't. So again, the strategy is large chart only. Your job is to manage that strategy correctly using the smaller chart. And then obviously, if you're short and you run into a bunch of Fibonacci resistances or supports that are from your synthetic fibs from the other time frames, the large chart system chart only looks at one Fibonacci level from that chart. It doesn't have the additional Fibonacci levels. This is why you have to pay attention to your smaller chart so you can see if you run into a fib, or if you have divergence from a fib, maybe not take that next short because it doesn't work. So again, the system will stop trading when you get to a fib. But if the fib is only on your small chart, the large chart doesn't know about it. So again, when you just keep these simple, management rules in place, and again, if you take a long and you can trail your stop behind pivots, I'm going to go through some pictures and some charts and some examples and some really simple rules for you guys that's going to make you, or allow you guys to get the most out of your automated trading system from the large chart. So let's take a look at some rules first, and then we'll take a look at some examples. All right, so now let's go through the automated system from the large chart using the smaller chart. I put together some very simple rules, nothing very fancy. These are rules that you're going to want to incorporate on your smaller chart, and it's the same rules we've taught forever, but exit with higher or lower divergence. You're going to want to trail your stops when there are new pivots. You want to manage your positions at key areas. If you manage out, we're going to show you exactly how easy it is to look for a continuation re-entry if the rules on the large chart are still true. And then ultimately, when is it best to skip a trade? I would like for each of you guys to go through the trade management section in our user guide underneath NinjaTrader 8 indicators. Everything that we've taught in here, we've taught for so long, and really, really important that you guys preserve capital, maximize your performance, minimize the risk while you're using the automated strategy. Remember, in the automated strategy page, it says warning, 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 you might need to manage. Again, we've talked about it already that I want to incorporate a small chart and these management rules into the strategy. Version 1 only deals with the large chart. So one of the things that we're going to do, or one of the things that you have to do, is you have to look at your smaller chart, and remember, these are synthetic fibs that come from other time frames. If you look at your large chart, if you were running our normal template, you would have fibs here. The system only is able to look at one set of fibs. So as is, it doesn't look at the smaller chart or any other Fibonacci Fibonacci areas. So you guys have to do that. So if you are in multiple resistance with multiple divergences, you may not want to take a trade. If you do take a trade after resistances, you may want to wait until the small triggers roll up. Again, I put this picture in here because there's not a system trade here, but if there was and you decided I'm not going to take it or I'm going to get out of it, sometimes they win. So you want to have a simple plan and a simple set of rules for when to either get back in or maybe even take the trade if you don't like the precursor to it. And small triggers rolling up, especially from an area, that's pretty much the best spot where you've got the least amount of risk and then the most amount of reward potential to trade back into trouble. We're going to take a look at a lot of different slides here, and this is a system trade that happened. I don't remember what day this was, but it doesn't matter. They're all the same. The rules were true. We had divergence. The triggers were right. We got a pullback. We got an entry. The only bad thing about it is we didn't really make it down to fibs, and we didn't, it's not a bad bottom, but, we've got the mid band here. So the other thing that the large chart doesn't see, which we covered in the last one, is we had an exact hit of Fibonacci resistance from, this is a 55.8 time frame fib because it's the fattest synthetic. So it's from a really big time frame. So again, the system is going to get you in. You have to think to yourself, do I need to risk much beyond my trigger lines? And usually I kind of look at the last, synthetic triggers where they go sideways, and that's usually where you end up putting your stop. So instead of having 60 ticks worth of risk, which the system would have, you had very little risk, and then if you get a pivot from an area, you can pull your stop up a few ticks below that. So in this situation, we ended up with 1.25 points of risk for the same trade. And if you didn't manage your position, and again, let's finish the management of this one, and then we'll talk about it. Obviously, we get to resistance on the small chart again. You can take some money there if you want. Worst case scenario, get your stop to break even plus, because if you make divergence from a fib, it's not going to be really good for your position. So again, those are the types of things that you guys are going to have to watch and manage. And again, hit a fib, it could keep going. And if it does, great. You don't lose anything. You make more money. If it does hold and put in divergence, you won't lose any money. That's half of the battle right there. So as we go forward, we kind of look at what happened. Again, pulling your stop up behind pivots. For me, I kind of like a 1-to-1 with divergence is just get out. Or maybe you should have taken some money at fibs and 1-to-1s is not a bad idea. In this situation, we didn't. But anyway, this is better than the alternative. This is what it looked like if you were still in your position and you left a crazy ATM strategy stop in there, you're not going to be feeling very good when you're down $700, and then maybe down $1,200 if it hits the ATM stop. So manage and make $400-500, or risk $1,200 to leave your stop down way down low. And again, remember what we talked about. When you look at the historical, or you're running market replay on just the big chart at 500 or 1,000 or max 2,000 times speed, you can't really get a good feel for what happened on your smaller chart and how you would have managed it in the real world. And you may end up with 2 or 3 losers on the market replay running forward that would have been winners had you managed the position using all of our rules. And again, I have to preface this with one more time, we're going to add in small chart management into a future revision. So all the lifetime owners will get that at no cost. Once it's incorporated into the strategy, we'll be leasing a strategy once we get a potential demo version. However, we're going to charge an exorbitant amount of money for the lease. So if you guys do want to get a lifetime, now's the time. So if you're in that trade, or let's just say you exited the trade like we discussed at divergence from Fibonacci resistance, which is never a bad idea, and you're saying, I still want to go long because it says it's still going to go up, and we get divergence and the triggers roll over. This is the same spot we just talked about when the small triggers roll back up and they're above stuff like this, either from an area or above your triggers. This is the spot where you can get back into your long trade. So it didn't technically lose 60 ticks, so you'd still be in the original trade, but it's kind of nicer to make some money and then, get a second chance at it, make some money, and, obviously as you start to reach fibs and one-to-ones, and you can manage and put your targets manually wherever you see fit. And then ultimately trailing your stop behind pivots will lock you into some money and not leave a 60 tick stop in play. As we look at the chart, I want you to think about it. The system, when we reach this area, will still take another trade if we don't hit the fib on the smaller chart. If we miss it by 3 or 4 ticks on the big chart, it'll still do another trade, which it has an order in here. You see that? And you have to say to yourself, if this area holds, do I really want to do another trade? I just got out of my other trade. Do I want to do another one that close to the area if it holds? And again, these are the debates you're going to have to work through on your own. Now, this one, I'd put this one here because it's different. Notice on the large chart, we had Fibonacci support, we had a retest, the small triggers were above the large triggers, we put in divergence, there's plenty of room to get up to the next target. This is the ideal look for us, isn't it, for a trend trade long. So we really want to let the system take that long when we have a great bottom and such a great look, and you can see it did get in. And again, when you get in, you can always put your profit target where you have synthetic fibs or pivot stop outs. Also, again, the potential for a second lower divergence, probably not going to happen, but could. The other thing that I put in this chart for you that it scares everybody to death, and again, when you go back and you read through our documentation, you'll see that there's no reason to be. If you get higher divergences with the small triggers continuing up, people will count 1, 2, 3. And it's not really 1, 2, 3 if the small triggers continue to make new highs. It's just 1. This is 1. As far as a count goes. So just because you had 2 bars down and you made a divergence, when you look at the overall strength of the market, the location of price versus the triggers, there's no reason to think these divergences are going to end the trend. Coming off of a good bottom, especially. But that gives you the opportunity to still take this trade without the fear because you had divergence ahead of you. Once you realize that divergence with the strong triggers going with you, this one is counted as 1 and this would be 2. Hopefully that's helpful. And then ultimately, when we get divergence from a small chart and we get a trade that, how we're kind of straddling a Fibonacci resistance area, once we have 3 triggers through the way the default settings are, it's going to do another trade. And, again, this is where if you decide to let it trade, which I'm okay with, as long as you're inside these synthetic triggers over here, this is where, for me, I would say at a 34.5 down bar, which you can enable the 34.5 down bar on your synthetic fibs on your smaller chart. So this where the white reversal bar marker comes in. That's the max I would risk. So instead of having 60 ticks risk, which is huge, I would put, this is where the stop is from the strategy, because you'd get, resistance with divergence and you'd get below your large synthetic triggers. I wouldn't have it any farther than that myself personally. So I'd be risking 6 points maybe versus, a ridiculous amount, 15 points. Anyway, just food for thought on your stops and management, because if you start making down bars from Fibonacci resistance on your big chart, things aren't going to go real well. Anyway, this is where that stop would go, in my opinion. Best stop spot for it. Gives it a little bit of room, a little bit of breathing room, but not much rope. Because if it gets down there, it's going to keep going. So you don't need to risk all the way down to the fib. And then ultimately, as you get into the position and you start to make a pivot, because we are coming from a 50-50-ish, iffy area, get that stop up behind the pivot quick. So ultimately, this is risking, 1.75 points? In the big scheme of things in the NASDAQ market, 1.75 points is nothing. And then ultimately, as the trade moves up into the resistance, you can take some money off. If it makes a second lower divergence, you're going to get out, so you're break even plus. And then ultimately, it went through, which, look, only one of two things is going to happen at a fib. Strong triggers is going to break it, or the triggers are going to roll over and it'll go back down again. In this case, it did break through. And had you have gotten out, again, this is where I just wanted to show you small triggers rolling up. You might have a continuation long if you're so inclined. For those of you guys that do momentum trades through 1-to-1s, you might have a momentum long trade in there. And then ultimately, this is what ends the trend. And you guys are going to get real familiar with divergence and lower divergence. So if you were still long a runner, let's say, and looking for the yellow 1-to-1s, or you got back in again, manual trend trade, because the system won't do this one too far below, but let's say you did a manual trend trade. Again, lower divergence with the small triggers going down, get your butt out and don't lose a whole bunch of money. You can always get back in if the small triggers roll back above the large and you get a good chance. Otherwise, save your money, be patient, wait for things to line up again, and then everything will work out really well. Again, I don't know how to say this enough times. Divergence on the small chart ends most trend trades. Either divergence and lower divergence, or divergence and a pivot stop out of divergence. When you go back and study trend trades or the end of trends, you'll see this look a whole lot. So if you are long for, let's say you were long and then you managed out like we talked about. And then you said, you know what, Novak said wait and be patient, and then look, 2 divergences on the bottom, and then small triggers get above your large. That's your one more shot at a long. That's discretionary trading, but that's the continuation look to take it back up again. And you'll see that small trigger continuation look a lot, and you'll get used to it. Also, again, blue fib, so it's kind of a warning. Watch out. Strong triggers are through it, so we're going to get a trade. And you don't have to leave your system entry where it is. If you say, hey, look, it's just above the area, you can always move it down a couple ticks. So you're in full control of that. And then ultimately, this is another situation for me personally that I think, because we have a blue fib, and sometimes they just don't break and then it goes back up. For me, a max stop would be the 34.5 reversal bar again. And again, that would put it way above the triggers and the mid band. Now, that gives a lot of room, but it's still only 6.75 points. So it's not risking, 60 ticks. And then ultimately, like any other trend trade, if you get a pivot down, the system's going to leave a 60 tick stop in there, guys. Do you really, knowing what you know, want to leave a 60 tick stop in? I hope not. But you can manage with pivots, and then ultimately, you get the warning, blue fib on the big chart, and then all of a sudden you're really set up for a potential. You don't know if it's going to be actual or not, but higher divergence will be actual, couple ticks above the reversal bar marker on the smaller chart. So now we don't have to risk, but now we're down to 2 points of risk. And then ultimately it went down a little bit further, and a second higher divergence would put you in, basically you get to break even on this trade. Now, this is a warning. I put this one on here because I messed it up myself personally. When you're managing very close to where you got in the first time, think about it. If you leave your strategy enabled, it's going to say, hey, the rules are still true. And we're still on the same bar. Get back in again. So it's very important that you disable your strategy if you're going to manage close to where the prior entry was. And I didn't, and it actually did get me back in, and I was like, oh. So fortunately it bounced just a little bit, and I was like, let me put my stop at break even because I don't want to trade into higher divergence on the wrong side of my large triggers. That just doesn't work out when you have a blue fib and higher divergence. It goes higher almost all the time. And then ultimately, thankfully, I got out, and you can see what we feared the first time was true. Blue fib, fake out, breakout, I call it. The higher divergence told us so. We didn't have to lose any money in this situation. And had you have left your stop in way up here, 60 ticks, you'd be crying losing 60 ticks when you didn't have to lose but maybe a point or less. And remember, again, I've said it a million times, I'll say it a million more, I'm sure, before it's over. If the rules are still true and you like the look on the big chart, which I don't here, but let's just say it is, you can always go short again when the small triggers give up and roll over, either from an area or back below the large triggers, which there's no chance of that happening. So, again, it just becomes a great entry, a really good managed exit. You don't lose a bunch of money because you're waiting for some dumb ATM to get you out at 60 ticks loss. Please don't do that, guys. Come on now. Use your smarts and use all the good stuff and you're really going to love your system a whole lot more. The system does the right entries, but again, the system can't see the small chart. And that's next phase 2 in the automated world for what we're going to be doing. It'll exit with a higher divergence when we get that version written. My programmer's on vacation for a month, so it's going to be a bit, but the more you see this, the easier it is to incorporate into what you're doing. And then ultimately, again, when you get divergence from a high at Fibonacci resistance and you have an existing divergence on the low, almost every time this divergence will take the market down to here. And this is where the system's trying to get in, which for the system rules, it's correct. And for the big stop it's going to put in, it's okay. But again, maybe lean a little more towards the area inside of your triggers instead of the middle of nowhere. If you do get in, which I would let it get in just for this educational purposes, but this is what happened. The system entry got in and it went down to the support and 1-to-1 and pivot stop out, just like we talked. And again, I don't think I don't think you have to risk 60 ticks. If you put it below the last fibs and they get you, you can always get back in again. But look at the momentum we're getting into, and the difference between getting in at the better spot and getting in here is about $440. It's $110 a contract. That adds up very, very quickly. And then ultimately, had you got in at a better spot versus here, you'd be up 400 instead of down 400, but be that as it may. You still want to put your stop below a pivot, below the reversal bar marker from the 34.5. And then if they get you, you can always get back in later if the triggers roll over. Ultimately, it didn't go back down, which is great, and it started pushing up. And then we got to a trouble spot, large triggers down, fibs down. You don't have to risk any money. You can put it way down here if you want, but this is a look that I wouldn't risk any money, and I'd buy a break out of the fib if I get it. That's just me personally. And then ultimately, I want you to think of this as a statement. You can't see change coming if you're only using the large chart. I've said this. I got a picture from God knows maybe 2020 or 2019 where I said that the first time, but you can't see change coming from the big chart. That's why we use the small chart. That's why we teach on the small chart. That's why we have rules like 1-to-1s and pivot stop outs, and divergence is a termination. And a lower divergence is really a termination. If you were brave and said, I'm going to trail behind pivots, which is great, at some point you have to give up. And lower divergence, especially from 1-to-1s, you have to give up here. And then look, you make a bunch of money, you get out really close to the top, and you don't give back all of your money with good management. So again, just keep it simple, guys. Pivots, watch the key areas, higher, lower divergence. It's going to save you tens, if not 20s of thousands of dollars a month from the historical performance. A lot of you guys are overly fixated on, I ran replay and it's not making a lot of money. Well, when you go back and run replay, instead of running it at 2,000 times speed, run it at 10 times speed and watch the small chart and see where the small chart management will help you. And then think about the future revision of our software that will incorporate the smaller charts. I also, for those of you guys who want to purchase the strategy, on our prices, to click prices on our nextgent3.com website. And we added in the trend trade system down here. We're going to continue to do lifetimes. No reason not to. For those of you guys who do not want to pay $5,000 and do a lifetime, or you want to do a trial of it beforehand, that's okay too. It's going to be a couple weeks before we write all of that software necessary to make that happen. And then we plan on leasing it somewhere between $1,000 and $2,000 a month, especially after we write the smaller chart work in there. $2,000 a month is not a lot to ask for a system that's going to do all the work for you. Right now it does half the work. It does all the large chart work, which is great, and you have to do a little bit of the small chart work. Once the second half is written, it's going to be very, 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 very fancy. Anyway, I appreciate your time. I don't want to drag this on any longer. Have a great day. If you have any questions, please get with your salesperson that can address any questions, or talk to us in the Discord. And I appreciate you guys taking the time to listen.